Welcome to Subramani. In 1999, when I was contemplating selling off our NSE membership and going into retirement, one thing I saw was a lot of my portfolio had my portfolio had shares like Siemens and Cummins and even Colgate and HUL, which were not really big dividend paymasters. Make no mistake, they're big dividend paymasters, but compared to the market price, the dividend payout was very, very low, something less than 2%, maybe 1%, 1 to 2%. And I said, oh, this is a disaster, right? What I should be having is your Indian Oil, NTPC, ONGC perhaps, kind of companies which would pay nice good dividends so that the cash flow can help me live, right? That is exactly how you think that, oh, I need to now shift from A to B because I don't need any more, I need more dividends than I need growth. My growth phase is over, now I need to get dividends so that that cash flow can sustain my family. Then I realized that I can create my own dividends. So let me just explain. Of course, everybody loves dividend because it comes without application of any mind. And when I'm talking of dividends, I'm talking of only dividends from equity shares, right? I'm not talking of dividends from mutual funds. That is your own money coming back to you. In fact, it's now no longer called dividends. It's called something else. Go Google. So the question is, should you want a dividend-oriented portfolio where there is some chance that the value of the portfolio may itself erode because the company does not seem to be having any known ways of growing? Okay, let me digress a little. The dividend yield calculation is something which is not known to many people. So let me just explain. Dividend yield is calculated as dividend plus change in the capital in the price of the share. So if you buy a 100 rupee share and you get 10 rupees as dividend, that's a fantastic 10% yield. But at the end of the year, if the price is 89, you've got nothing because you've got 10 plus 100 minus 89 or rather 89 minus 100, so minus 11. So you got 10 minus 11, you got minus 1 on an investment of 100. That's not the way to get a yield share. A yield share has to at least hold the price, if not adjust to inflation. Ideally, if you buy a share for say 100 rupees and it pays you 10 rupees as dividend and the price is 107 at the end of the year, that is the best, right? Because that 107 is just the inflation adjustment of the price. So your share was worth 100 rupees, end of 1 year it has gone up by 7% and it has paid you 10% dividend. That is how you calculate dividend yield. Sorry, that was a digression. So I decided that I would rather look at a company which is growing at a very good pace. So shares like Bharti Airtel or Reliance and those kind of shares became far more attractive than to buy a share which was just giving dividend yield, because dividend yield after some time can be very boring. And it also means it's an industry where they have no clue what they want to do with the excess money. So you only want to invest in good companies which make more correct decision and less wrong decisions. So typically, if you go to a Tata Group, did they make a mistake? Of course they made a mistake in Tata Tele, right? They lost about 30,000-40,000 crores. That is exactly the kind of money which Birla has also lost. But you know that they would make a lot of right decisions. So maybe Tata Motors was a right decision, maybe Birla Finance was a right decision, maybe buying a lot more cement capacity right now, trying to buy more cement capacity, that maybe those are the right decisions. You want the companies to make more right decisions than wrong decisions. That's about all, right? So here, if I can reinvest my money and get 7% return, and I find that there is a company like say an Indigo or a Patanjali who can reinvest the money and get 11% return or 13% return, I would rather have them not pay me dividend. Are you understanding what I'm saying? I'm saying I'd rather have invested in companies which do not pay a dividend, because dividend, when it comes to me anyway, I have to pay tax on that, whereas I can let the company keep the money, grow it, and whenever I want dividends, I will sell that many shares. So that's about all. Let's say I got 10,000 shares of Patanjali. When I need money and the share price is say 2,000 rupees, then I want 20,000 rupees, I'll sell 10 shares. I want 2 lakhs of rupees, I'll sell 100 shares. I can create the dividend myself. It is like being in the growth option of a mutual fund and deciding when you want money. Whenever you want money, you sell a little bit. So I got say Patanjali 10,000 shares worth 2,000, and this is what I do. 5 years later, I've got say 25,000 shares of Patanjali, thanks to some bonus or split or whatever, and the shares are quoting at 4,000 rupees. I need 4,000 rupees, I'll sell one share. I need 4 lakhs of rupees, I'll sell 100 shares, right? So a caveat, all the examples which I have given are shares which I hold. I hold Indigo, I hold Patanjali, I hold Cummins, I hold Siemens, I hold HUL, Colgate, Pfizer, whatever I have mentioned. So fairly obvious that I'll give examples from my holdings. So I'm saying I started looking at companies from a different point of view, saying whenever I want dividend, I will create it. In 99, dividends were tax free, or rather taxes were being paid by the company, and capital gains was zero. So I was indifferent to whether I was getting dividend or whether I was getting capital gain. Now I'm more clear that I want more capital gain and less dividend. So I would rather be in growth companies and create my own dividend rather than buy dividend oriented shares. It's not that I have anything against. I have, let me go back. I have IOC, I have SAIL, I have Coal India, I have all the PSUs which pay out huge dividends. I have both of them in my portfolio, both types. The growth ones are not the ones where I'm looking to have any cash flow, and the yield ones are the ones where I'm looking to good dividends. And when I bought Coal India at 119 or something like that, I was getting a 10% dividend yield. Today the dividend yield on the market price is not high, but still in terms of cash flow, it puts a lot of cash in my hands. Like when I bought Cholamandalam, etc., in 2 digits, they were very good dividend paying companies. So I bought it for the dividend. Now it has given me growth. So don't get lost too much into this dividend versus growth and growth versus value, etc. Go and build a good portfolio. Some of the shares will pay you dividend, which is good to meet your day-to-day needs and cash flow, assuming that you're retired like me. And some of it will keep growing, which you don't need the cash, right? So the Indigo goes and buys more planes, buys more offices, hires more people, trains more people. You know they're doing all that to improve their market share. Similarly, when Maruti or Tata Motors invest in new technology, you want them to do that. You don't want dividends. You want them to invest in technology, grow the market, grow the business, make profits, and then whenever you want dividend, you can create your dividend by selling Maruti or Tata Motors or Indigo or whatever you, right? You don't want the company to worry too much about paying dividend. So you create a portfolio where some shares pay you dividend, because that gives you comfort, saying, oh, somebody else is doing all the thinking. They are deciding that this is surplus, they don't need, so they're paying me dividend. Very good. And some shares where you create your own dividend by selling the shares whenever you need, right? So I could give you an example. You set up a business with a friend, and your friend says that we should take a 25% dividend every year, and you tell him that no, what we do is we will not take any dividends, we will just keep growing the company, we will take a salary, and whenever we want money, we will dilute stake, which could be very small. We could give a 1% stake as the price goes up, rather than withdraw the money as dividends. Let's take salary, right? So any of these things you could do. But largely, if a company has got a good ROCE and a good ROA and a good ROE, you want the company to keep the cash with itself and reinvest. Of course, there will be a limitation. After some time, they will tell you that we don't need so much cash, and they start returning your dividend. That is the time when you start thinking, is it worth holding on to this company? Maybe it is out of its growth prospects. That's perfectly all right. Right, I don't think I'm worried too much about HUL or a Colgate sale not going up by 25% quarter on quarter. It doesn't matter. I know the company has got dividend, good brands which give good returns, which will give me good, fantastic ROA, right? On the assets that I own, I get good returns. That's good enough for me. So yes, buy shares which can give dividends, but also it's very important, especially if you're young, to buy growth shares and create your own dividend. Thank you.